On October 7, 2024, a new chapter of the long-standing conflict between Hamas and Israel unfolded, with devastating consequences. A region synonymous with history, culture, and sadly, conflict. The recent escalation of violence has sent shockwaves far beyond its borders, shaking the global economy. From New York's trading floors to small-town America, the impact is felt by everyone. This is not just another regional conflict, it's a stark reminder of our interconnected world. The question on everyone's mind is, how bad will it get and how long will it last? Since the conflict broke out, global oil prices have surged. The Middle East, particularly countries like Saudi Arabia and Iran, supplies nearly 1/3 of the world's oil. With the risk of the conflict spreading, especially involving Iran, fears of supply disruption are pushing energy costs higher. The Red Sea has seen a massive reduction in tanker traffic, impacting not just oil but the movement of goods worldwide. Investors are becoming more cautious. Stock markets have reacted with increased volatility, and companies with exposure to the region, like travel and tourism sectors, are suffering. Central banks around the world are already struggling with high inflation. With rising oil prices, we could see central banks maintaining high interest rates longer than anticipated, leading to more expensive borrowing for businesses and consumers alike. So what should you do as an investor? This isn't the time to panic sell. Instead, consider diversifying your portfolio. Sectors like energy may benefit from rising oil prices, while precious metals like gold, often seen as a safe haven during global uncertainty, are gaining traction. At the end of the day, global events like this remind us how interconnected our economies have become. Whether it's oil prices, supply chains, or financial markets, these conflicts can affect us all. What do you think? Will the market see further turbulence, or will things stabilize soon? Drop your thoughts in the comments, and if you found this breakdown helpful, make sure to hit like and subscribe for more updates on how global events shape the economy. At the heart of global economic anxiety lies oil. The Middle East, home to vast oil reserves, plays a pivotal role in global energy. Any disruption sends tremors through the energy market with wide-reaching consequences.
The current conflict has highlighted this vulnerability. Oil prices have surged to multi-year highs, impacting businesses and consumers alike. The black gold factor will continue to cast a long shadow over the global economy.
The impact of soaring oil prices extends far beyond the gas pump. It's not just about the cost of filling up your tank, it's a catalyst for a series of economic changes. It triggers a domino effect, impacting prices across the board. From the food we eat to the clothes we wear, everything becomes more expensive.
Transportation costs, heavily reliant on fuel, are among the first to feel the pinch. Trucking companies, shipping lines, and airlines all face higher operational costs. Rising fuel costs translate into higher shipping costs, impacting consumer prices for goods. This means that everything from electronics to everyday groceries sees a price hike. Rising energy costs also affect raw materials and manufacturing, fueling price increases. Factories have to spend more on energy, which in turn raises the cost of production. Central banks face the challenge of managing inflation and supporting economic growth. They must carefully balance their policies to avoid economic downturns. Raising interest rates too quickly could stifle economic activity, while moving too slowly could allow inflation to spiral. It's a delicate balancing act that requires precise timing and judgment. The ripple effect of rising oil prices will continue to be felt for months, if not years. The long-term impact on the global economy is profound, affecting everything from consumer spending to international trade.
The Middle East is a critical crossroads for global trade, serving as a vital link between the East and the West. Its strategic location makes it indispensable for the movement of goods and resources. Strategic waterways like the Strait of Hormuz and the Suez Canal are vital arteries for goods. These narrow passages handle a significant portion of the world's oil and cargo, making them essential for global commerce.
These choke points are also points of vulnerability, susceptible to disruptions. Any blockage or conflict in these areas can have a ripple effect, causing delays and increasing costs worldwide. The recent conflict has highlighted the fragility of these supply chains. Infrastructure damage and geopolitical tensions can severely impact the flow of goods, leading to significant economic consequences.
Fears of disruptions have led to increased shipping costs and delays. Ports become congested, and shipping companies face higher insurance premiums, all of which contribute to rising expenses.
Manufacturers reliant on the region may face production delays or shutdowns. The lack of timely deliveries can halt production lines, affecting everything from electronics to automobiles. Consumers may experience shortages or higher prices as businesses pass on costs. Empty shelves and inflated prices become common, affecting everyday life and economic stability. The need for diversification and resilience in supply chains has never been more apparent. Companies are now exploring alternative routes and strategies to mitigate risks and ensure a steady flow of goods.
Global financial markets have not been immune to the turmoil. News of the conflict sent shockwaves through stock markets, triggering sell-offs and volatility.
Investors already grappling with inflation fears now face geopolitical risk.
This flight to safety reflects a broader unease and lack of confidence in the near-term outlook. Sectors sensitive to geopolitical risks like travel and tourism have been hit hard. The interconnectedness of the global economy means shocks in one area can quickly transmit to others.
Investors are left grappling with how to navigate the storm and protect their portfolios. The uncertainty can be overwhelming, but there are strategies to help manage the risks and find opportunities even in turbulent times.
Firstly, diversification remains paramount. Spreading investments across various asset classes can reduce exposure to any single market downturn. A well-diversified portfolio can help mitigate the impact of volatility. This means including a mix of stocks, bonds, real estate, and other assets.
Secondly, seeking professional advice is crucial. Financial advisors have the expertise to navigate complex markets. Financial advisors can provide tailored guidance based on individual risk tolerance and goals. They can help create a personalized strategy that aligns with long-term objectives.
Lastly, market downturns are a natural part of the economic cycle. Patience, discipline, and a long-term perspective are essential, and a long-term perspective are invaluable for investors. Staying calm and focused can prevent hasty decisions that might harm your portfolio.
By embracing a strategic approach, investors can weather the storm. This involves regular portfolio reviews and adjustments as needed, and emerge ready to capitalize on market recovery. With the right mindset and strategy, the storm can be navigated successfully.